Hello friends, last week in my video I told you that volatility would spike. It was a period when typically Santa Claus rallies occur in the market, and B, what you had was pro-cyclicality stepping in and replacing counter-cyclicality. Now when these two phases are briefly, but ever so briefly, overlapping, there is a huge bout of volatility that an average retail trader is unable to bear. Now, in this video, at the fag end of this video, there is a special segment which I have recorded wherein I discuss whether bulls, the average retail guy, will he be able to revive the markets with his sheer buying power, which he has been doing since the last couple of years. Now, don't skip that segment. As usual, this video is divided into chapters and you can view the chapters at will. Now, let's jump into the usual format of our video. And on your screen right now is the weekly market roundup, which tells us that it was the bank Nifty which led the way down. Not very surprising. I've been telling you that interest rate sensitives were going to take a drubbing. I've been warning you about that. Based on the cost of funds theory laid out by Dick Stoken, and the broader base Nifty 50 brought up the rear. The US dollar index continued to surge higher, although it retraced lower from the 108 level that it had scaled intra-week. And that exerted downward pressure on commodities, and you saw gold and silver both come down, oil come down, gas has gone up due to seasonal factors. Do remember, it is a fuel of choice for indoor heating during the winter months. Now, the Indian rupee continued to fall against the US dollar. It ended at 85.08, which means we are basically likely to import inflation, as I had recorded in a special video, as you can see on your screen very recently. Please do view that. Now, the Indian 10-year benchmark bond yield went up by 6 basis points. That tells me that bond prices came down. That was one of the many reasons why banking stocks fell, due to the mark-to-market loss on the bond portfolio. The NSE lost a whopping 4% in market capitalization, which is not exactly good news. I have been telling you in my past videos that anytime you see 3% or more weekly declines on the NSE market capitalization for 3 or 4 consecutive weeks, do note that a very high probability exists that a bear market would be beginning. So this is week 1. We'll have to see what happens in the coming weeks. Market-wide position limits, or MWPL, rose 1.83%, which is routine after expiry, before expiry, I beg your pardon. And the US headline indices all fell, thereby providing headwinds to our markets. Friends, I now come to the ratio chart of the Bank Nifty divided by the Nifty 50. Second consecutive week of declines, and I told you I would want the Bank Nifty versus the Nifty 50 ratio to go up above 2.35, if not 2.45 levels outright, before I can say that the rally is sustainable. Now, why is this ratio so important? It's because of the weightage. The weightage of the banking and financial sector stocks in the Nifty itself is humongous. This is a swing sector, and without this sector, no sustainable rally can be assumed. Friends, I now come to our in-house indicator. I start with the market-wide position limits. In my humble opinion, this is quite simply the most important in-house indicator that I share with you. The tutorial to this study is in this video. The hyperlink to all the videos that I want you to see are in the pinned comment below this video and in the description below this video. So the MWPL chart on your screen tells you it's a weekly chart spanning 20-week look back period, that of late, at least in the last 3 derivative expiries, which is October, November, and now coming up December, the MWPL has been making a lower low and a lower high pattern. Now at 35.64 in the week just before expiry, it is the lowest that you have seen in the 20-week period covered by this chart. That very clearly means that retail traders are not creating as many long positions or even short positions and rolling them over to the next day. Now that basically tells you, and do remember the peak is at 45%. We are at 35.64, which is almost a good 25% lower from the peak. That tells you that retail risk appetite has clearly shrunk. Now, friends, I come to the stock and index futures turnover. This is again a cumulative total of the entire traded week, and this includes all three derivative series. So it is December, Jan, and Feb. Now, after bottoming out in the prior week, the turnover has started going up again. Do remember, last week we have seen a humongous 4% plus declines in the headline indices and the turnover rising. Part of it, of course, is due to the expiry when traders are closing their expiring month futures and options trades and rolling them over to the next month series. So there is a double turnover recorded here. But in spite of that, the fact that markets have fallen on higher volumes tells me that there has been a good amount of distribution at higher levels. Now, friends, I come to the advanced decline ratio after the price itself. This is the most leading indicator. The Nifty having fallen 4.77% last week, the advanced decline indicator is almost at the lowest point in the 20-week period. At 0.56, it tells me that there were 56 gaining stocks for every 100 losing stocks. Not very good. So if at all the markets were to rally again, you would need the advanced decline ratio to go above 1.0 and stay above that with rising prices. Unless that happens, I think bulls are on the ropes. Now, friends, I come to the Nifty and Bank Nifty prompt futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Just like the options premium, basis also tends to erode as expiry comes closer. Now, the Bank Nifty basis is marginally positive, just about there, whereas the Nifty basis is comfortably above the zero mark. As long as the basis is not inverted. By inversion, I mean the futures trading at a discount to spot. I think this is a natural wear and tear, so to say, for the want of a better phrase, in the basis and is routine ahead of expiry. But if the basis was to turn inverted, I would say that short sellers are getting aggressive. So let's keep our ears to the ground and monitor these indicators. Friends, I now come to impetus, our in-house exclusive indicator. You won't find it anywhere on the internet. And what you have seen is that the impetus readings of both the indices, particularly the Bank Nifty, have jumped very sharply last week. Coming in a week when prices have fallen sharply, it's not a great sign at all, which tells me that the fall last week was on a great deal of selling momentum, selling pressure. That tells you that bears were showing signs of aggression, which, believe me, is not a great thing to have happened. So, unless the impetus rises on rising prices, I think the bulls are at somewhat of a disadvantage right now. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. It stood the test of time for almost 4 years. You've trusted it. It's delivered as per expectations. And last week, I told you that the LWTD indicator, which had sunk in last week's video at minus 0.63, I told you fresh buying support was going to be very poor. Sure enough, the Nifty has fallen 4.77% last week. Admittedly, the LWTD reading has risen to minus 0.43, but do remember, it's still in the minus. What it means is that there could be a little more short covering than was seen in the week gone by. Why? Why? Because more of long positions tend to get rolled over on expiry, and many of the short sellers tend to square up their positions. So I'm not surprised that the LWTD, even though it is in minus, has moved up a little bit. That it is not a bullish sign. It merely tells me that there could be a little bit of short covering on declines. That's it. Friends, in-house indicators done. I now come to the bond market, which is the crux of my theory of the cost of funds, which I devote so much time and attention for. And I utilize this in my options theta decay trades extremely extensively. Now, I have been telling you to stay away from gilt funds, as also lay off from buying the 10-year sovereign bonds in a laddering fashion. Now you see why. Check out the chart on your screen. You see how the Indian 10-year benchmark yield has almost gone up by 7 basis points. Now, this is not something that many people were expecting. I have been telling you that I, ideally speaking, would want interest rates to go up. Yes, you heard that right, up. Although the experts in the market are telling you that interest rates might go down, I admit they might go down due to compulsions that the central bankers are facing right now. But economic sense dictates that interest rates not go down, which is what the Fed's guidance was midweek last week, saying that even though they might cut rates in 2025, those rate cuts may not be as prolific and as aggressive as were previously expected. What happens? Do note that cost of funds, like I have been saying, are likely to go up. That's exactly not very good news. If by now you have studied Dick Stoken's books that I have recommended to you, you would know what impact other financial assets have when cost of funds goes up by a mere 25 basis points, quarter of a percentage points. You are talking about cost of funds having gone up significantly more than 25 basis points. What happens next? You would know by now if you've studied Dick Stoken's work. All the best to you. Friends, the bond market's done. I now come to the bank Nifty, which the daily chart on your screen tells you fell on 5 out of 5 trading sessions, thereby logging losses of 5.25%. The price is below its month-long moving average, which itself is edging lower. That tells you that the short-term outlook is nervous as of now. The price is at the trendline support of a very loosely formed bullish wedge. A short covering bounce can occur any time, but the overhead supply comes from bulls who are trapped at higher levels. When they wait and see their prices come back in the market, they come out and sell. So the overhead supply will be sizable. Also note, it will be more of an enticement rally. Enticement is when you basically entice somebody or fool somebody into going long because you want to distribute stocks at higher levels. So I think a dead cat or a technical temporary bounce can come back, but it will be more of an enticement by the smart money to rig up prices ahead of expiry to entice the bulls, a retail bull, to roll over their long positions and incur more interest expense in nursing their longs. It is very possible that after retail traders have carried their long positions over, prices might come down again. Now let's go to the weekly chart, which shows a fall to the lowest point closing in 5 weeks. The price is also below its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average retail investor. So the medium-term outlook is nervous as of now. The weekly candle is a sizable par candle and the fall has been on higher churn ratio, which I will share with you in the fag end of this video in the last chapter, which tells us that selling was very proactive by smart money participants. In the week before last, this index was ranked number 5 on the most volatile counters list based on statistical beta rankings that I maintain in-house. It rose 2 notches and wound up the week at number 3. Not good news. Believe me, a headline index rising up in volatility ranking tells you that standard deviations or statistical beta, a pure form of intraday volatility, is not something that you as a retail trader may be able to handle without doing damage to your capital account. Now, last week I advocated an estimated range between 55,225 on the upside and 51,950 on the downside. Admittedly, our systems could not forecast the big decline that occurred because the Bank Nifty made an intra-week low of 50,609. Now, in the coming week, the estimated range is between 52,575 on the upside and 48,950 on the downside. There exists a possibility that this range can also be breached due to higher volatility. Friends, in addition to this range, please also monitor the daily, weekly, and monthly pivots that I share on our free Telegram and WhatsApp channel, and also this video on how to use our pivot points so as to laser precise your entry and exit levels on the indices. Friends, the Bank Nifty done. I now come to the Nifty 50, and as the daily chart on your screen tells you, this index also fell on 5 out of 5 trading sessions. It lost 4.77% in the bargain and closed below its month-long moving average, which itself is turning lower. Last week, I mentioned that this index is bullish only if and only if it stays above the 24,750 mark, which was a strict prerequisite before any rally could be validated. Now, on Monday itself, bulls failed to hold the 24,750 mark and this index closed below it, which negated the inverse and therefore bullish head and shoulder pattern, which I have shown as a blue color coding, and the price fell from the larger previously formed bearish head and shoulder pattern, which is shown as a red marking. And as per the Dow theory, whenever two signals occur, one on a longer term chart and one on a shorter term chart, it is the signal of the longer time period that gains precedence over the shorter time frame. The larger previous bearish implication head and shoulder neckline acted as a resistance, and the Nifty fell from there on Monday itself and never really recovered. Do remember that this 24,750 hurdle remains in place, and the Nifty must trade above this sustainably before bulls can be said to be back firmly in the driver's seat. The coming week is a very unique one. It's a short week thanks to Christmas on Wednesday, and Thursday you have expiry of the Nifty and the individual stock futures and options. And being a year-end, FIIs are likely to be thin in their participation, so volumes are going to be bad. A little bit of buying and selling, and prices could make outsized moves in either direction. So volatility is likely to be very, very high. Now let's take a look at the weekly chart. It again shows a bearish power candle which has violated the 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average bull. That means the market outlook remains nervous as of now, even for medium-term investors. Expiry-related short covering can always come and cause bulls to basically rescue the markets temporarily at least. But like I said, I want 24,750 to be overcome sustainably before I can go out there and bet long. Friends, in the week before last, this index was ranked at number 18 on beta rankings based in-house. It jumped 10 notches and closed at number 8. That's a humongous jump. Now at number 8, a broad-based index with 50 constituents being so volatile tells you that an average retail trader is likely to find the going fairly challenging for him. Now last week I estimated the range between 25,425 on the upside and 24,150 on the downside. Here again, my support level was breached by a big margin, and the low was 23,537. Ouch, that's a big margin. Now in the coming week, I estimate a range between 24,300 on the upside and 22,850 on the downside. Here again, the range might be breached. Remember, it's a short week and expiry, so volatility will be off the handle. Also, please monitor our daily, weekly, and monthly pivots and our pivot tutorial video here so that you can laser precise your entries and exits. Friends, I come to the last bit of last bit of statistical analysis wherein I gauge the retail risk appetite by way of the footprint that the retail segment has built in the four segments in the F&O space. Now, index futures turnover contribution went up by 2 basis points, indicated as a blue line. Stock futures turnover contribution went up by 26 basis points, indicated as a red line. Index options turnover contribution fell by 49 basis points, indicated as a green line, and stock options turnover contribution went up by 21 basis points, indicated by a purple line. Net, I would say risk appetite remains robust. The retail guy is still nursing a bullish hangover, and therefore he is rolling over his positions of whatever positions that he is holding relatively more than what I thought he would have. Now, whether it means he will go out there and rescue the market by buying afresh aggressively, or it means he's just going there by force of habit only to take a knocking, time will tell in the coming 4 trading sessions in the week ahead. I now come to my trading strategy for this unique week, which is going to be a holiday shortened week. First of all my new trades that I will initiate will be in the January series. There's no point in trading afresh in the expiring December month. Now, my advice that I gave in my Moneycontrol column very recently, and the hyperlink to that column is in the pinned comment and description below. I very categorically said, use this Santa Claus rally to exit long positions. Now, I don't believe in being a perma bull, or for that matter, a perma bear. I am a slave of statistical data. I go where the data indicates, and the data was very clearly saying, it continues to say that selling on rallies is still the way to go forward, right? So the picture perfect advice of using the Santa Claus rally to exit from long positions was exactly as I advocated. I continue to remain of the opinion that theta decay in interest rate sensitives is the best way to go forward. At least that is what I would do. Please don't miss the last segment of this video wherein I have talked about whether retail bulls can revive sentiments in the market. Interest rate sensitives are covered in greater detail there. Where crude oil is concerned, theta decay strategy would continue there, whereas natural gas is going up due to seasonal factors, which I have been telling you year after year. In the winter months, natural gas is the fuel of choice for indoor heating, and many newbies start talking about a bull market, although it's just a seasonal uptick. Metal mining companies' stock prices will also be a lot more volatile with a bearish bias because of the fact that industrial metal prices are witnessing downward pressure on commodity exchanges. This goes with my view that there is no super cycle in the commodity space. Now, bullion is coming down exactly as I had advocated in this video, and it's actually good fun to hear all the obituaries being written about gold and silver. And as long as there are no negative surprises, a battle plan is still in place. Now, my battle plan of looking beyond 2024 and maybe even beyond 2025 for holding on to long positions in both gold and silver remains in place. The story is as robust as ever. None of the underlying reasons why I advocated buying bullion have disappeared yet. So the story still remains intact. Now, friends, I come to that segment which I promised you I would record for you. Can retail traders revive sentiments? Now, let's take this point by point in a very, very methodical and calculated manner, which you and me as doers of deeds are. There is no place for sentiment here, and we need to take a very mathematical, cold, calculated approach as to what is happening. Now take a look at the daily chart on your screen. What do you see? The first thing that strikes my eye is after 4th of June. Every month, bulls have been hammered by mark to market margin calls and cost of carry month after month for 6 months in a row. And many of the bulls would have surrendered their long positions after suffering many of these mark to market payouts. Of course, they are being replaced by newer guys who are coming in and buying thinking the market has fallen enough. But just because you say market has fallen enough does not mean the market has to bounce up. That's just an opinion. The numbers are very clearly saying that MWPL, remember I told you in the previous graph, was making lower tops and lower bottoms formations. So the numbers are not indicating that bulls are in any hurry to revive sentiments, not at least the retail guy out there. But wait, there's more. So let's discuss. Now, the rising inflation will basically take the edge off our ability of an average Indian household to save more money and consequently make smaller deposits. That means interest rate sensitive stocks are likely to remain in the limelight, and volatility is likely to stay elevated. Now, this is a boon for theta decay traders out here. So, as long as bulls, at least the retail guys, are continuing to make the same mistake that they have been making in the last 6 months, not only are they ignoring the cost of funds, but they are paying rollover charges, financing charges, execution costs, taxes, levies, and exchange charges month after month, hoping for higher prices. A theta decay guy will take these charges from an average retail guy. So the dice of a guy who's paying interest, the dice is loaded against the interest payer. In my video on the rupee being at an all-time low, I talked to you about inflation and shrinkflation. Inflation is when prices are raised for commodities. Shrinkflation is the price is kept constant, but the grammage or the weight is reduced. In that video, I talked about Hind Unilever, how it's raised prices by 5% of its most popular FMCG products and reduced the grammage, the number of grams it serves per unit in per packing, by another 5%. So the hit that an average retail buyer is taking is 10%. Last week, Parle has resorted to shrinkflation. They've reduced the serving size, and the hyperlink is in the description and pinned comment below this video. So Parle has cut the weights and grammage, and that is another confirmation that inflation is likely to stay elevated. Higher inflation will basically impact interest rate sensitive stocks the first, and my theory of theta decay in these stocks remains in place. Is the dice in favor of interest payers or interest receivers? You decide. Pro-cyclicality will sap the strength of an average retail trader who doesn't know what it is like to basically gauge the cost of funds. And if he doesn't know what happens when counter-cyclical phases are replaced by pro-cyclical phases, you as my online family will know, because I've recorded these two videos many months ago about pro-cyclicality. Both these videos, part 1 and part 2. I would request you to see them again, even though you might have seen them earlier. So you know what pro-cyclicality is, how it replaces counter-cyclicality, why the volume goes up sharply, and how cost of funds is the final nail in the coffin of the counter-cyclical markets. So an average retail Joe is continuing to bear that interest cost burden and the execution cost, taxes, commissions, etc., and he's hoping to win. Hope. Strategy wins, not hope. Now, can the markets bounce higher? Of course they can. Markets can always bounce higher due to short covering. Do remember there's an expiry ahead. Now, how does big money entice the small guy to come out there and buy? They push prices higher, especially ahead of the expiry. Now, you're going to make the small guy come out there and increase his cost of purchase by adding rollover cost. He needs to be convinced that there is hope. How do you bring him hope? You push prices higher. Maybe it will happen in the expiring week. Maybe it will happen a fortnight down the line. I don't know. But all I know is that bear market rallies are pretty vicious. And they often fool a newbie or a rookie trader into believing that the worst is over and hey, it's time to buy again, buy when everybody is fearful, and all those cliched statements that social media is so full of. I know that enticer rallies will come. I know that dead cat bounces will come and bear market rallies will be very vicious. But unless my statistical data models tell me that the worst is over, I would rather listen to the numbers than the words echoing in the echo chambers out there. Now, take a look at another chart on your screen. This is our in-house indicator, the churn ratio. I have plotted three things on this chart. Number one is the price of the Nifty itself in rupees. Very simple. Then there is a market-wide churn ratio and the Nifty's prompt month futures churn ratio. What do you notice? The first thing that strikes my attention is there's been a vicious fall in the Nifty in the last 5 trading sessions. And coinciding with that fall is a huge spike in both the Nifty and the market-wide churn ratios. I told you in this video of MWPL, I have also added a very brief description of how to calculate the ticket size per trade and the churn ratio per trade. I told you that churn ratios are raised whenever the smart money wants to create smoke and dust in the market. Why would smart money want to create smoke and dust in the market? So that the vision of the retail guy gets impaired. Now, why would the retail guy's vision be impaired when the market is diving down and the churn ratio is high? It's very simple. Somebody wanted to distribute stock and they did. Which is why the churn ratio went up. Which is why I keep telling you statistics play a much better and reliable role as a hand-holding tool than emotions do. So do rely on data to base your decisions on. Now remember that easy and abundant money at low cost is like mother's milk to a bull market. The recent announcement by the RBI that it would make lending by unregulated and unregistered entities illegal. Up to 1 crore of rupees will be paid in penalties and anything between 7 to 10 years of imprisonment will follow. Which means that a lot of private money lenders will be going out of business. And therefore, small and large businesses which require funds will have to go to the organized sector for their loans. Which means that there are fewer guys who are doling out loans in the market and therefore there's a very high probability that cost of funds will go up even higher. Now, when cost of funds go up, as a student of Dick's token, and I'm assuming that you're my online family who's studied Dick's token's work exactly as I told you to do since many, many months. What happens when cost of funds go up to asset prices? There's no rocket science here. You don't need to do any guesswork. It's on the wall. Now, for my punchline. It doesn't take you too long to go to a free charting website and take a look at all the FNO stocks, particularly the index heavyweights, the heaviest weighted stocks in the index. Tell me, how many of these stocks which have seen the most amount of MWPL increases? Remember in this video on MWPL, I told you it's an excellent psychological hack. It's an excellent psychological tool for a behavioral technical analyst to use. Now, the most amount of MWPL concentration has been in PSUs, has been in interest rate sensitives because of their 34.5% weightage in the broader base markets. And tell me, how many of these stocks have dropped more than 10% from their recent peaks? Do remember, as per the classic Dow theory, a 10% or higher fall in the market price is equal to a substantial correction. And a fall of exceeding 20% is a bear market. So calculate how many PSUs, how many stocks, MWPL, how many index heavyweights, non-heavyweights, SMEs, MSMEs have basically come down by more than 10%, more than 20%, and are therefore in the bear market territory. You know what? The worst is over when these stocks that have fallen 10% plus and 20% plus recoup lost ground, absorb all the overhead supply that is existing at higher levels where people have got trapped, absorb all this selling, and then go up again. Then I would say, yes, the worst is over. Till then, you're shooting arrows in the dark. Clutching on to hope is not a bad idea. But do you have the staying power to stay hopeful, continue to bear cost of carry? I'm talking of traders here, not investors. If you're an investor, how does it matter to you whether you bought at 100, seen the price go down to 20, keep averaging all the way up to 20, you're hopeful of the price coming back to 100, all the more power to you. But as a trader, you'll be dead. I'm addressing traders here. Unless the overhead supply of all these stocks is accumulated and absorbed, I don't think the worst is over. Till then, it's kite flying and wishful thinking. Will I be updating data as and when I feel the worst is over? You can count on me to do that. What do I want from you in return? Hey, I will never charge you money for providing any commercial services. We don't do that. We are traders. We are real world traders, prop traders. We derive our income from the market, the mother market. It feeds us. All we want you to do is share our work with fellow like-minded smart traders and investors like yourselves so I can spread the cult of knowledge-based investments and trading. If there are any more ideas that I wish to share with you, I will be more than happy to do so on our free Telegram and WhatsApp channels. Before I wind up this video, I remind you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become a better trader and what I can do to continue to help you understand the concepts of statistical trading methods even better. I wish you Merry Christmas in advance and a very, very happy new year ahead. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Have a profitable week ahead. Bye-bye.